Of the many decisions you make as you're purchasing a home, one of the most consequential is whether or not and how much to pay for something called discount points. Points affect your rate, your payment, your cash to close, the overall cost of your loan over time, pretty much everything. And it's not a one-size-fits-all decision. The lowest rate may seem like the best option, but is it? And how do you figure it out without feeling like you're throwing a dart at a board? Well, that's where the tool I'm going to share in this video comes in. It's our points analyzer. And I initially created it for myself, but I want you to be able to make fully informed decisions for yourself. So we're going to make and share a custom points analyzer for you and your loan. And if you love spreadsheets, you're in for a treat. But even if you don't, hang in there, because after this quick tour, I think this one's going to feel approachable, maybe even verging on user-friendly, but most importantly, you'll be able to make good decisions about points for your loan and avoid potentially costly mistakes. And if this video surfaced somewhat randomly in a YouTube playlist for you and you're not already a client, I suppose I should take just a second and introduce myself. I'm Julee Felsman, and I'm a residential loan officer, and I'm licensed to lend in all 50 states, and I'd be happy to chat if you're in the market for a lender. And before we dive into the tour, I have one other little piece of housekeeping I want to take care of, and that is to mention that I have another video that takes a far deeper dive into points. It goes into the backstory, where points come from, and what they really are from a conceptual standpoint. You can check that video out at the link above. This video is practical. It's a tour of the points analyzer, the tool that we use to decide whether or not and how much to pay for points on a specific loan. I'm going to go through what's in each section, how to interpret the numbers based on your goals and your timeline, and use it to find the optimal balance between monthly payments and upfront costs. So let's get started. First, we're going to get the lay of the land. And the points analyzer is arranged in lettered sections. And I'm going to give you a quick tour from top to bottom, going on down through each one to give you a high-level overview of what's in each section. But before doing that, I want to point out the obvious. I've entered very specific numbers into this so I can give you a tour of the document, how to use it, what calculations it's running, and what's in each section. But needless to say, when you're making decisions about your own loan, please use your own points analyzer and just use this as a guide to understand what's in each section. Starting at the top, Section A is just data entry. This is where the team and I are going to plug in the specifics of your transaction and the property you're purchasing and so on. And all the rest of the math is going to filter down and make the magic happen in the other sections. Section B is really where the things you probably care about the most will live. And that is, how much money have you got to show up with at closing, and what's your monthly payment going to be? And in this section, the monthly payment is principal and interest, the loan, but also property taxes, homeowners insurance, if mortgage insurance is applicable, and if you purchased a property with homeowners association dues, those will be in there as well. And you'll probably see 6 different interest rate options. And that's really the point of this sheet. You have an option. You've got to make a decision as to which interest rate you prefer. And I hope at the end of this tour, your points analyzer is going to help it make it really clear which one is the best fit for your expectations and plans and goals. Now I'm going to skip section B2 and come back to it at the end because it's only applicable if you've negotiated to have your seller pay a temporary interest rate buy down. If you have, I'll get to that in a minute here, but I want to move on to section C because this is really where we see points. And the points are going to be reflected both as a percentage of your loan amount and the dollar amount in a cost or in a credit. And the monthly payment in this section is just principal and interest. We've stripped away the stuff that isn't relevant to the decision that you're making here. Taxes, insurance, mortgage insurance, HOA dues, they are what they are, but it's really the principal and interest part of your payment that's different depending on which interest rate you choose. There's some other math in this section that I'm going to come back to, but I want to move on to lifting the lid on the principal and interest payment in section D. And what you'll see here are 6 different time intervals. We'll choose things that kind of make sense to us in terms of thinking about things, but if you have a specific time frame in mind for the loan, let us know and we can enter that here. In this example, I've got it set up with 1, 2, 3, 5, 15, and 30 years. And in this section, you're going to see at the end of each one of those time intervals, how much cumulative interest have you paid and what's your remaining principal balance? And I'm going to talk about that a little more in a minute. But first, I want to move on to section E, and that's our cost flow schedule, which is set up as a heat map. And this is where I think you're going to get the most value out of this document, probably where you'll spend the most time looking at it. So it's where I want to start doing a little bit of a deeper dive. The cost flow schedule is arranged with a row for each month of your loan. If you applied for a 30-year loan, you'll see 360 rows. If you applied for a 15-year loan, you'll see 180 rows and so on. And then there's a column for each one of the interest rate options that we saw in the sections above. And before I talk about what's in the intersection of each row and column, what all these numbers are, I want to pan back to the big picture for a second, talk about what it is we're trying to do, which is minimize the cost of your loan in dollars out of your pocket. So how do we do that? Well, the most important element that we need to think about is time. And I call this out in the points cheat code here, because if you think you're going to have a loan for a short period of time, the interest rate doesn't matter very much. Over a short window of time, you're not going to pay very much interest, period. So the difference from one interest rate to another isn't very impactful. But paying many thousands of dollars of extra closing costs, that's super impactful. And if you flip that around, if you're thinking, gosh, this is my forever house, I'm not optimistic I'm going to be able to refinance, I think I'll have this loan for a long time, then you may be paying on this loan for decades. And you're going to pay a tremendous amount of interest over that period of time. And investing a little bit of money up front, maybe even a lot of money up front, to buy a lower interest rate that's going to benefit you for that long period of time can really generate some huge savings. But here's the thing. Very few of us know exactly how long we're going to have a loan. Maybe you can refinance and you're optimistic about that, but what if that doesn't happen and you get stuck with the loan for a longer period of time? Maybe you think it's going to be a super long-term loan, but life throws curveballs and you wind up moving, or interest rates fall and you get lucky and you can refinance. You need to kind of strike a balance. And the way that I've designed the cost flow schedule is to give you enough information to really see how things look over different periods of time so you can find that balance. And the way I suggest using it is to make your best guess for how long you're going to keep the loan. Then look at that row and you can quickly see which option is going to be the least expensive. And then you can think about your degree of certainty and what happens if you have the loan over a longer or shorter period of time, and try to find this option that strikes the best balance. So what's in all these cells that we see over here? Let's say I think I'm going to be able to refinance in 24 months, and I look at this row for 24 months. What's each one of these cells telling me? Well, it's really my total cost for the loan that I'm seeing. What did I pay up front? Did I pay discount points or did I get a lender credit? Whatever the case is, that's in that number. And then what have my total monthly payments been over that period of time? In this example, 24 months, some of that was interest that went out the window that I'm never going to see again, but some of it paid my loan down. So let's adjust for the fact that, hey, we're paying the loan down a little quicker at a lower rate, a little slower at a higher interest rate. And the aggregate of those three things, your money up front, the principal, and the interest in your loan, that's what you're seeing in each one of these cells. So you can, if you know exactly when if we knew we were going to refinance in 24 months, then it's really simple to see, well, gosh, obviously I want the highest interest rate option. That's going to be the lowest cost. What if I don't know that? Well, I can sort of start finding that balance. I can look at, okay, well, for 2.5 years, that's the lowest cost option. But, once I start getting into 3-4 years, it starts making sense to pay some more points up front to buy that lower interest rate to get the benefit of the lower interest rate over time. And you're going to have to go through that thought process for yourself. But I want to throw one other element into the mix, and that is that if you are optimistic that interest rates are going to come down and you're going to be able to refinance, and that figures into your thought process, you should remember that refinancing isn't free. And we can help estimate the cost of a refinance so that you can take that into account when you're thinking about what your overall decision should be with regard to the rate and the points that you choose. Next, let's jump up to the top of the page and take a closer look at section A. It's mostly data entry that we'll take care of, but there are a couple of things that I want to call out. One is you probably haven't gotten a quote for homeowners insurance at the time that we're putting your points analyzer together. Once you do, that actual number will replace the placeholder that we've entered here, and that's going to affect both your monthly payment and the amount of money that you have due at closing. So keep that in mind. Two, I want to mention that there are a couple of places where seller credits can show up. And I guess more accurately, I should say stuff that the seller could be paying for will show up. One of those is down here on the line marked seller credits. If you negotiated for the seller to pay a credit towards some of your closing costs, first of all, well done. And second of all, you'll see it here, whatever that amount is. But there's another spot where things the seller could be paying would show up. And that's in this fees split with seller section. The first line here is BAC or buyer's agent commission, buyer's agent compensation. And if the seller's paying 100% of the BAC and you're not paying any of it, one of two things will be true. Either these two boxes will match each other, or we may be a little lazy and just leave it out and you won't see anything there. But if the seller is only paying a portion of the BAC, let's say they're paying $10,000 of this $12,500, then you will see the $10,000 they're paying here and the $2,500 that you're paying will show up here and be part of the money that you have due at closing. Let me go ahead and change that back. And then the other thing I want to call out is this closing cost line. You may see a number in this box here that is a little bit bigger than what you've seen on loan summaries that we've sent your way. And if that's the case, that's because by tradition, where you're purchasing your home, the seller picks up the tab for certain closing costs. When we prepare a loan summary, we just show the costs you're going to pay. There's no reason to show things the seller could pay. But when we put a loan estimate together or a points analyzer, both of those documents will show the total number, everything, and then an offsetting credit for the amount the seller is going to pay, and the amount you're going to pay will show up here. And that should line up more with what you've been seeing on the loan summaries that we've provided previously. Now, mortgage insurance is a widely varied topic, and so I've set up this example that we're looking at for a traditional monthly mortgage insurance premium. You may see something quite different here. I'm not going to go into all the possibilities in this video, but if you have questions about what you see in the mortgage insurance section, just let us know. And the last thing that I want to call out is earnest money. You'll pay a deposit that's going to go towards your down payment as you get your offer accepted, usually within 2 or 3 business days. We're inconsistent. We may show your earnest money here in this box, like I've shown in this example. If we have, then when you look at section B, which we're going to jump to next, remember that we've already applied a credit for the earnest money that you've paid, and don't mentally deduct that again. But if we didn't show the earnest money here, if it isn't in that field, then you've already paid that money. You will get a credit for it, and you can make a mental adjustment in your cash due at closing for the earnest money that you've already paid. So we've already talked about most of what's important in section B. Your total monthly payment is here. The amount of money you have due at closing is here at each one of these 6 different interest rate options we're considering. But I want to call out one other thing, and that is that we have this sheet set up to keep track of something really important, and that's that there are limits to the amount of money that a seller can credit to you. There are loan rules, and we'll keep you posted on the rules applicable to your loan so you can keep an eye on that. But also, seller credits can't exceed your actual costs for closing costs, prepaids, and points. And if you look at line 1 here at 6.99%, you will see a little red note telling you that we've exceeded, the seller credit exceeds your costs. And if this is the case, there's good news and there's bad news. So the good news is the seller is paying every penny of closing costs, and all you have to bring into closing is your down payment, and that's it, not a penny more. The bad news is we've left money on the table. The seller agreed to pay some money that we're not spending, and we kind of don't like leaving money on the table if we can help it. We want to try to find a way to spend it to your benefit, and there are a number of ways that we can do that. But if you run into this situation and you see that, just know that means you're potentially leaving some money on the table, and we want to have a conversation about it. So now let's talk about points in section C. So how do points work? Well, if you pay more in points, increase your points, you lower your interest rate. And if you pay more yet, you lower your interest rate further, or you can turn that on its head and go, I'm okay at a higher interest rate. I want lower points. And if you raise your interest rate enough, you can drop your points down to zero. And if you raise your interest rate further, your points go below zero and they're no longer a cost to you, and they're actually a credit paid to you. They actually have a name change at that point. Instead of being called discount points, they're called a lender credit, but it's the same mechanism at play. So let's look at this example that I put together. We have interest rates going from highest to lowest, and as you'd expect, the monthly payment is going from highest to lowest as well. And just to the right of that, we've calculated each stair step of savings. So if you went from 6.99 to 6.875, you save $37 a month, and from 6.875 to 6.625, another $79 a month, right? Just in this example. What's happening with points? Well, the points at 6.99 are not points. They're a lender credit. You're receiving a credit from us of $2,900. And that's on top of, in this example that I made, a $10,000 seller credit. That's actually why we were leaving money on the table at 6.99%, because the lender credit plus the seller credit is more than the total of your costs, right? Now, if we went from 6.99 to 6.875, the credit shrinks. It gets smaller. It goes from $2,900 to $1,300. It costs you $1,567 more to close because the credit shrinks. And if you wanted to go to 6.625, now you have to pay $1,724 in points. That's an extra $3,000 relative to 6.875. And you could go all the way down to 6.125, but you'd have to pay $11,500 in points. And remember our heat map? Well, that's why the highest interest rate, the lowest interest rate is the highest cost option over a short period of time, because you're only saving, you're saving hundreds of dollars a month, but it takes a while before hundreds of dollars are going to pay you back for that extra $11,500 up front. Now, off to the right, we're taking that logic and doing a little math with it. And it's what I call a quick and dirty cash flow break even. And it's what a lot of people really begin and end with when they're analyzing points. And I'm not going to say it's wrong to think about it, but it's an oversimplification. So I think it's a mistake to end there. But let's talk about the math. So let's say you went from 6.875 to 6.625. You lost a $1,325 credit. You had to pay $1,724. That's an extra $3,049 that saved you $79. So if we divide that $3,049 by the $79 a month that it saves you, it's going to be 39 months of payments, $79 a month at a time, before that extra $3,049 is back in your pocket. And that's the math that you're seeing here, just a little bit over 3 years. Now, I say it's an oversimplification because as your monthly payment drops, as your interest rate falls and your monthly payment falls, the makeup of your monthly payment changes. And we need to lift the hood and look into the payment and see how the breakdown between principal and interest works out. And that's actually what we do in Section D. Section D is a lot of numbers, but it's also kind of fun because some of it's intuitive, but some of it's a little bit of a mind bender. Now, as I mentioned before, we'll choose time intervals, and 6 of them. In this example, 1, 2, 3, 5, 15, and 30 years. Interest rates are a little elevated right now. We're crossing our fingers that a lot of the clients, as I'm recording this video, that we're getting loans for will be able to refinance in the relatively short term. So we're interested in what loans look like over a short window of time. But if you have a window of time you're interested in, let's say you're curious to see what things would look like in 7.5 years, then we can enter in whatever you'd like to see in this section. So what you'll see under each one of these time periods is 2 things. And the intuitive part is that as your interest rate is lower and lower and lower, at the end of this, in this example, 1 year period of time, you'll have paid less interest. And that totally tracks, right? Lower interest rate, less interest cost. Easy, makes sense. The thing that's a little bit of a mind bender, I think, is that you're paying a lower interest rate. That means you have a lower monthly payment. You're paying less interest, but you're also, even though the payment is lower, paying more toward principal. You're paying less every month and paying your loan off faster. And you can see that even after just a 1 year period of time, you at 6.99% would have paid your loan down to 470. At 6.125%, you're almost down to 469. It's not a huge difference over a 1 year period, but it's not nothing. It's almost $1,000. But let's jump out to 7.5 years. So over 7.5 years at 6.99, you'd be paying $238,000, $207,000, $31,000 less interest, and your principal balance on your loan is over almost $7,000 lower, while paying less interest, while paying a smaller monthly payment. Now, you can spend some time looking at this, and it is kind of fun and interesting, but honestly, the cost flow schedule has this built into it. That's part of what is taken into account and kind of turned into a visual in the cost flow. So enjoy it. If you have a time frame you'd like to have us plug into your points analyzer, just let us know. Section B1 is where we talk about temporary interest rate buydowns. And we offer 5 different kinds of buydown. In this example, I've entered what is far and away the most common temporary interest rate buydown, which is a 2-1 buydown. First, I want to talk about what a temporary interest rate buydown doesn't do, which is lower your interest rate. The name is a little bit of a misnomer. It does, however, lower your minimum monthly payment for a scheduled period of time. So let's talk about how that works. With a 2-1 buydown, for the first 12 payments that you make on your loan, your minimum monthly payment is based on an interest rate 2% below your true rate. So let's say in this example, you chose a 6.625% interest rate. Your minimum monthly payment for the first 12 months would be based on 4.625. That would lower your payment by $599 a month. Not bad. Your second 12 months, your minimum monthly payment would be based on 5.625, which would lower you'll stair step up, but still a lower minimum monthly payment by $307 versus your true full payment, which will kick in after that first 24 months of payments, and the discount goes away. So how does this magic happen? Well, it happens because at closing, we collect money from the seller and we establish a savings account, a subsidy fund. And in this case, that subsidy, which is exactly the cost of your discount over those 24 months, is $10,877. So you get a lower minimum monthly payment courtesy of money that the seller gives to us at closing. And fun and important fact to the side, if interest rates fall and you get the chance to refinance, or you win the lottery, or whatever happens and you pay your loan off, you move and sell, any money left in that subsidy fund that hasn't been paid out in subsidy to your monthly payment is credited toward your loan balance. So a temporary interest rate buydown subsidy fund can wind up offsetting some of the cost of a refinance, which is kind of nice. But our sheet is set up to keep track of something worth noting, and that is that, remember, we assume that the seller is paying $10,000 in credit, and we've got a subsidy that's $10,877. And the sheet has actually given us a little heads up that, hey, the seller credit isn't actually high enough to cover the subsidy, and you're going to be chipping in $877 to cover a portion of that subsidy. Now, if the seller credit was bigger, let's say you negotiated a $15,000 seller credit, well, now we've got ample funds for that $10,877. And in fact, there's money left over. There's another $4,100, which is going to be credited toward your other closing costs and reduce what you have due at closing. I'm going to change this back to $10,000. And if you watch these numbers while I do that, you'll notice that they go up a little bit because we have lost that extra $4,100 of credit, and you're back to having to chip in a little bit to cover the cost of the buydown subsidy. If you've negotiated for a temporary interest rate buydown, this is where you'll see it. But if you have questions about the possibilities there, or using that as a way to spend some seller credit that we might be leaving on the table, you'll notice it fixed that problem for us. Let us know, and we'd be happy to talk through the possibilities. I hope this tour helped the points analyzer make a little more sense, but I really hope your points analyzer makes the decision about paying points or not on your loan a whole lot easier. And remember, there's not really a single right option. The best choice is the one that best balances your financial priorities over the timeline that you expect to have your loan. And if you're a client, of course, my team and I are available as a sounding board to help interpret and talk through the numbers as you make decisions about locking in your interest rate. And if you're not a client and you've watched this video this far, we should probably talk. So reach out anytime. You can text or call this number or grab my contact information or schedule a call using the link in the caption below. And I'd really love to know if you found this video helpful. So please give it a like, subscribe to my channel, drop a comment below. Thanks again for watching and for trusting me and my team with your mortgage.